As we move forward, I'd like to remind everybody that today's summit is not just about listening, but also participating and connecting. We have a stellar lineup of speakers and panelists who are leaders in their fields, and we encourage you to engage with them, ask questions, and make maximum use of this unique opportunity. I hope everyone's feeling energized after that wonderful presentation by Mr. Nadella, because we have an exciting panel coming up. But before that, as you all have registered for the lucky draw, we will be announcing the winners throughout the day, so stay tuned. All right, so public markets are increasingly turning to AIFs to diversify their portfolios and seek higher returns. AIFs encompassing private equity, hedge funds, and real estate offer unique opportunities to manage risk and capitalize on emerging investment trends. And our first panel of the day will talk exactly about how public market investments are being reshaped through alternatives. It's going to be a fascinating discussion with some of the brightest minds in the industry. Please join me in welcoming our esteemed panelists, Mr. Pankaj Tibrewal, founder and CIO of IKIGAI Asset Managers, Mr. Sameer Shah, co-founder and portfolio manager at ValueQuest Investment Advisors, Mr. Shahzad Madon, managing director and CEO of TCG AMC, Mr. Vaibhav Sanghavi, CEO of Ask Hedge Solutions, and Mr. Senthil, Chief Business Development Officer at Kfin Technologies. Please give a round of applause for our esteemed panelists.
Good morning, all of you. So we are really glad to have this kind of an August gathering. And today we have an esteemed panel. And the topic is also very interesting. It's talking about the public markets. So just to set the context, so before we hear from the stalwarts of the industry, see, overall, as an economy, we have been growing, and the economy has been very resilient. Despite global markets, there has been a bit of turmoil. We had a little bit of gyrations because of the election. But long-term, structurally, the markets have been pretty poised for a growth. And the alternate investments, the amount of money which is getting channelized, especially into equities, is significantly higher. As we speak, yesterday SEBI released the report, the total commitments of AIFs have crossed 11 lakh crores. So globally, alternates are close to about $22 trillion. So we just started like about 10 years back and we are at 11 lakh crores. So that's the kind of growth which the industry is happening. So if we include InvITs, REITs and PMS, this number is far more larger. So considering this, how much of the money is getting channelized into public markets? As we speak, out of the 11 lakh crores, close to about 9.5 lakh crores is into private market, whether it's private credit, private equity, VC, or real estate credit. So the amount of money which is being channelized into public markets is close to about 13%. Whereas globally, if you see, it's about 25% of the investable money in alternates is into hedge funds. So are we heading towards that is going to be deliberated with the current panel. Since most of them are from the market, so maybe I'll just ask each one of the panelists to just give an overview of what the markets, what is the view on the markets, the macro, or on the alternate investment industry itself. So maybe we'll start with Shahzad.
Sure. Thank you for having me. Thank you for this wonderful event. I would put it this way, that I believe we are all blessed to be born in this time and blessed to be operating at this point in time. If you look at it from a market perspective, fundamentals and macros are extremely strong, whether you look at GDP growth, you look at fiscal deficit, you look at any parameter, current account deficit, very, very strong. From an election perspective, clearly continuity is there and the people believe that there is continuity. Earnings, if you look at the last few years, we are all very impressed with the growth which we've seen, which is a function of two things, which is earnings growth as well as, let's call it, PE re-rating. When you look at the earnings growth, which has been pretty good, but there has been a lot more which has come of the returns which have come from PE re-rating. Now the PE re-rating, to my mind, is to a great extent, a very significant extent, because of the way the market is seen, which is seen as a lower risk market, great macros, very, very strong fundamentals. So, and the interest rate differential between US and India is very much lower than what it used to be in the past. So that probably reflects greater confidence in India. By no means are, when you look forward, by no means the market cheaps. I mean, at least I think it would be very difficult to make that case. Right? Things are pretty much priced to perfection. In some places there are bubbles or mini bubbles, if you will. But by and large, a market is reasonably valued. The important thing is growth and how growth comes through. We've seen RBI numbers. RBI talks about a 7.5% growth, add inflation to it. Things, I think we are on to a reasonable wicket where earnings growth should grow fairly strongly. Right? In terms of risk, I think things are so cheery, so positive. It's very, very difficult to see anything at this point in time. But that's what risk is. You don't know what will come and hit you, but probably it comes from overseas. Lastly, I'd just say one of the things which exercises a lot of people, which is, when you look at the money flows, which is coming in and the domestic money, and as long as money comes in, people believe that it will, markets will keep going up. I think I'd put it in the following manner, that flows, at least domestic, are structural. Given the savings rate, which, let's put it this way, we have a $4 trillion economy, 25% savings rate, as a young population, money from EPFO, as well as the discretionary money which comes through mutual funds, SIPs, AIF, PMS should continue to grow. So we are on a very good wicket, and I'll probably end where I started off from. This is a golden time for everybody in the capital markets, for investors firstly, and also for participants like all of ourselves. And we should, as long as we don't do anything silly, I think we are on to a very good wicket.
So thanks, Shahzad. So Shahzad talked about the valuations, fundamentals, and liquidity. So I know each of you can talk for 2 days also on markets. So let's keep 2 minutes for each of you to just succinctly cover about the view.
So I share what Shahzad said from a longer term perspective, but let me take a cautious stance right now. I think market is clearly overvalued in lots of pockets. I don't know what will bring markets down because it's a herd mentality. It's very difficult to change immediately. But if you go into the history, there are 4 instances when markets kind of take a setback when there is exuberance. First, when there's macroeconomic challenges. We have seen that in 1995 Asian currency. We saw that in tapering tantrum 2013. The second is when household, governments, corporate takes excessive debt. We saw that in 2007-8 in US on the mortgage crisis. Third, when there is political or social instability, and we have seen in the past various reasons that markets take a setback. And fourth, when there is a man-made or natural disaster or a pandemic like COVID, markets take a setback when there is uncertainty. The first 3, India is well positioned. We don't see anything happening. The fourth then is anybody's call. Nobody knows what happens tomorrow. So when you go into the history, the 4 reasons when markets correct fundamentally for a long time, you don't see on the horizon. But I believe that the valuations are finally slave of earnings. I feel that earnings have started to slow down. Last year we saw 30% earnings growth in NSE 500 companies. But when I dissect the 4th quarter numbers, it's a little worrisome. In the 500 companies, 88 companies are BFSI companies, which grew their earnings by 24%. But the 413 non-BFSI companies, which largely is mid-caps, small caps, and the broader market, grew their earnings only by 7.5%, which means that the broader market earnings have started to slow down. And finally, at some point, markets may take cognizance of that. And a large part of stock returns which you saw has been a function of valuation, P rating. And I think that something which should be careful about. The easy money, in my view, is behind us. We saw last 2.5 years of, very strong momentum, broad-based momentum into the market. It's wise right now to take a somewhat a cautious stance right now, evaluate risk in the portfolio. Today you talk about risk, you feel like a fool in the marketplace. But I think it's wise to take a careful view on the portfolio, on the risk people are carrying. And in my view, many pockets will not see the stock price come back for the next 5 to 10 years also, whenever they correct this time. So just be a little careful on what kind of a risk you are carrying in the portfolio. It will help you navigate the next 12 to 18 months, which I feel will be very narrow market. It will be a sideways market. Maybe large caps may do much, much better than the broader market space, where there is some valuation comfort. I know I am a party spoiler right now, but my job is to make sure that investors navigate this compounding story properly over a period of time. So next 12 to 18 months, I believe it's time to be a little careful in the markets and monitor the risk in the portfolio.
Thanks. Samir?
Yeah, so, I was at a ET event a couple of days back, from the RBI governor to state bank chairman to, everybody. Macros have never looked better, and there is a cheery consensus in terms of, how Indian macros are standing out vis-a-vis the world. So we are at a great place, right time. And because we are so close to the story, there is always skepticism. India is a story of 2 steps forward, 1 step back. So it disappoints both the optimists and the pessimists. That is how India has been. So I share, valuations are maybe 1 standard deviation or 1.5 standard deviation above. But what is to say? I mean, market keeps making a new high. In terms of economic cycle, in my view, it started in 2019 with the tax rate cut is when the market cycle also turned. So, this bull market is maybe, which started in 2009, had a dip in COVID, but has a lot of shock absorbers, both fundamental and technical. So I am not in the camp of any kind of a crash that is going to happen. There is always going to be a bull market somewhere. We have to believe in equities, believe in India. Yes, I mean, you can have sideways. 2022 was a sideways correction. There was a 15-month zero return. We all did not feel it, and I still feel that is how it is going to be. The economic cycle has just started. Government capex is firing, real estate is firing, private capex about to fire, consumption or, the bottom end of the pyramid or the farm income is the only place of, concern, and maybe exports. So these are the 3 things. So from our investing point of view, we know what to avoid. Obviously, if you are going to be in those spaces, then I agree with Pankaj. There will be long periods of no return. We've seen it, in the largest banks or whatever. So you have to be, in this bull market also, are we able to find stocks which have zero performance for 4 years? Yes, it is. Which means that the market is discerning. Market is not, in some pockets, has thrown caution to the wind. But in general, I feel, that will always be there in a market where there is so much money chasing, etc. We should not take those anecdotal things and miss the bigger forest for the trees. I remain bullish. I think this will be the best asset class. India equities. We can't expect what we made in last 3 years to continue. I mean, that's stupid. But will we, get the best bang for our buck in terms of returns? Risk calibrated. I think there are enough ideas still in the market, and I'm not in the camp of. So for us, as a business also, we are okay to take inflows. It's our choice when to deploy, how much to deploy, where. So risk management obviously has to be there. You cannot expect these last 3-year party, this thing. But the party, according to me, will continue. And people on the sidelines, people who have been waiting for the market to correct, are going to keep waiting. That's my view.
Vaibhav, closing comments, maybe you can consolidate and...
No, I think
because everything is covered.
Yeah, let me take a very objective view about this, in the sense that while we have arguments on both the sides, which is being, that the economy is fantastic, long-term growth opportunity is there, let's take a step back and understand the last 4 years where you've seen some good size return coming onto the markets. It has been because while the earnings were strong, of course, but it has also been because one of the biggest contributors, which is the domestic investor. Okay. Now, if you see, in 2021 September, when Fed actually turned in terms of their interest rates, typically what you see is whenever they start hiking rates, you see huge amount of redemptions from an emerging market as a basket. Okay. And if you see in the year of 2022, India being, at that point in time was about 8-9% in terms of the weight, actually witnessed about $20 billion of outflows only in the year of 2022. Now, if you would have taken that kind of outflow 8 to 10 years ago, then you would have seen markets actually correct by about 25-30% easily. However, on a calendar year 2022, we didn't correct at all, purely because of the massive and a consistent inflow from the domestic investor. And that PE re-rating, what we have seen, apart from, as I said, good earnings trajectory, has been because of this consistent inflow coming in, from the wider spectrum of participants. Now let's take in the next 3 years or 4 years what we see about this liquidity flow, and of course the earnings which Pankaj did allude to is basically that we are seeing some amount of softening in terms of the earnings. It is where Fed is now on the verge of starting to decrease interest rates. I'm not saying that it would be very aggressive, but whenever that kind of decrease in interest rates happen, you generally see good size inflow coming back into emerging markets. And now when the inflow is going to come into emerging markets, mind it, we are now at about 18% weight of emerging market basket. Okay, we are at about 12-year low ownership in terms of an FPI in India. So when the flow comes, my sense is, again to second the opinion of Pankaj, is that the first, I would say, first deployment or first, attraction would be the large caps, and where the valuations are still reasonable in that sense, relatively. So you may see for a shorter period of time, when inflows are great from an FPI perspective, domestic investors continuing their investments, you may see some amount of euphoria coming back to the frontliner large cap space, which is likely going ahead. The risk only to is if we grow slower from an economic standpoint and an earning standpoint, mind it that we are paying a higher valuation to something. So the gestation period for your desired returns on a fundamental basis kind of increases a lot, right? So that's the risk factor which one has to take into account. But from a flow perspective, from a technical aspect of the market perspective, I think we should be good.
So very well summed up, Vaibhav. So just to put things in perspective, so we are in a long-term structural bull market driven by liquidity, valuation, and fundamentally, like Pankaj and Samir mentioned, fundamentally strong. And just a cue which I can take from the panel is like be biased to large caps. Okay. So now, Pankaj, I'm little more inquisitive to understand. Of late, there has been large number of asset managers from mutual funds transitioning into AIF. So we saw initially it started with Sunil Singhania, then it moved on to Madhu Kela, then Prashant Jain, and you have been managing one of the largest funds in Kotak. So now you have started your own alternate. So even though both are public markets, it's completely different altogether. So what prompted you to just make this move, and where do you see there's in terms of difference between both?
So quickly, 3 reasons. I'm a great believer in history. And when you look at US from 1980s to 2010, exactly if you want to understand India and consumption patterns, US is the right case study. They were also at $3.5 trillion economy. And most of the legend or the great institutions which you are seeing today, their seeds were born around 80s. Most of them moved out of the established platforms, started their own boutique asset management companies, investment firms. And in the next 20, 30, 40 years, these platforms are some of the names to reckon with. I think India is exactly transiting in the same manner. I completely agree platform brands are important, but finally this job is all a skilled job with individuals and team people being important. And if you ask my overall thought process over the next decade or 15 years, you will at least see 10 boutique investment management firms out of India having a global name. And the casing point is White Oak. Look at Prashant Khemka. Started it 6-7 years back, managing $8 billion. You meet any FI of the world, they don't talk about established platforms names first, they talk about White Oak and Prashant Khemka. That is what he has created at a global stage. The next big name which probably you are going to see is ValueQuest. You look at some of the sovereign funds, you speak to them, they talk about ValueQuest. I mean, this is what India will create over the next 15 years. That was the first reason. I think we have a long way to go. The second reason is, I am a Madu. Finally, it's not easy to take a call when you are managing $7 billion. Easily 5 years, it should have been about $10, $15 billion. But I saw this opportunity coming in over a period of time. And out of my 20 cousins, 19 are in business. I was the black sheep. So on an honest answer, I also made the jump. So that's the second point. And the third point is that one of my secret thoughts which I wanted to share with you is when I look at companies, when I look at promoters, and when I select businesses, promoters between 40 to 60 years of age in India have created the maximum wealth over a period of time for every stakeholder. Go back to 30 years back, look at the entire Infosys gang, TCS of Chandra of TCS, Mr. Uday Kotak of Kotak, now Bajaj Finance twins, both Sanjeev, Rajiv, and so on and so forth. There are many, many examples, outliers may be there. When I try to apply it to myself, I'm in that bracket right now. So what I do for others, why can't I do for myself and create a larger platform? And I believe that at IKIGAI, this is just the beginning. The way we are structuring ourselves, investing into the business, my view is that the three fundamental core values, trust, process, performance, should continue. These are the three golden values for our platform. And if you ask my wish list, this platform should outlive any of us in the organization today. That will be the achievement over the next 20, 25 years. And I think India is exactly moving into that platform over a period of time.
Thanks, Pankaj, and all the best for your
Thank you.
new endeavor. That 40 to 60 still keeps probing me. Also hope Srikanth is not there around. So now coming back to you, Samir, like we just talked about mutual funds. So you have been traditionally a PMS fund house. And for you to just move into AIFs, and what we have seen is like of late there is huge amount of inflows happening into AIFs over PMS. So don't you think this is going to be detrimental, or like the incremental flows into PMS could be a challenge because you have two competing products? That is question number one. And second is like you've always been in public markets, but when you launched your AIF, you just launched a first private equity fund. So maybe like what prompted you to do this?
So I'll take the second one first. It was a big decision. First it was prompted by, taxation as well, that, Cat 2, Cat 3, Cat 3 taxation being a little, gray area. And we were considering, see, we are player who want to run a marathon. There is no shortcut, nothing. We've been 14 years in the business, and after that, so it's been only PMS focused, long term, long only PMS, and we've developed a track record, size, scale. But so two things that we have realized, that PMS as a product or separately managed account as a product, and we don't do model portfolio. We do non-model portfolio, what is right for the client. And then that there is some challenge to scalability as a PMS if you don't cut. I mean, we want, the best returns and, whatever. So AIF is a product, PMS is a service. So that, for us, PMS is not a product, it is a service, it is separately managed, it has to be customized, it has to be personalized. And as in India, the wealth grows. Overall, Indians have discovered the power of equity. And, as the wealth grows, you see, the kind of number of billionaires and, startups and whatever else. And sovereign wealth, what he alluded to, $7 trillion of sovereign wealth money, 100 billion is in India still. Even if 1% shifts to India, that's $70 billion more. So in terms of the size of the opportunity, we are just getting started in terms of flows. We are getting very aggressive when, 10, 12,000 crores of mutual fund SIP inflows, we thought it is, big number, now 20,000 crores. So there will be a time where, domestic plus FII will be $100 billion flows, and Indian markets have the breadth and the depth to absorb that kind of money. So for us, product and scalability, AIF is the platform where scale can be created, where you can create a product with a difference, and then, that is where you will be able to service a larger number of customers. PMS should be smaller number of large customers who want some kind of personalization. So that is how we are thinking. And why private equity? Because if you see now, the companies which are coming to the market are coming much later in their life cycle. Earlier, the Infosys or HDFC banks of the world got listed very, very early in their life cycle. And so all the wealth creation you were able to do. So today, whatever is the market cap of the publicly listed companies, if I were to have an equivalent, I think 30-40% of that is the market cap of the private market. So private market has come of age. There is breadth, depth. Again, liquidity is not so much of a problem, and we do late stage. So it's basically trying to capture these companies a little bit early in their evolution cycle also and the valuation cycle also. So that is what, and their regulations are clear, tax regulations are clear. So you have now in India, and so for me, I mean, you needed, whenever regulator, actually regulation is best if the regulator gives clarity, both tax and the market regulator gives clarity on things, then that is where market evolves. And lastly, just taking from Pankaj and him, this has happened in US. If you see, so mutual funds did a great job in trust in equities. Today mutual fund have a particular size, etc. But it is a little bit more straitjacketed, and as in India wealth grows, they want some kind of extra. So if you see US also 20 years, in terms of wealth creation, in terms of profit pools, and again, we look at the profit pool more than the size. Size doesn't matter, bottom line matters. He's a Madhu, I'm Gujarati, so, and in terms of bottom line in US and in terms of wealth creation, if you see alternatives, profit pools are now bigger than mutual fund profit pools. And we've seen, how the regulation moves, etc. Again, similar kind of thing is going to happen in India, and I believe AIF profit pool will be bigger than mutual fund profit pools in the country someday.
Yeah. Thanks, Amir. So just to summarize, you mean to say that it is not going to be a cannibalizing effect, it's going to be complementing. Definitely. So now coming to you, Shahzad, you and Vaibhav has been, unlike Pankaj and Samir, they are new entrants into the alternate space. You have spent, since the inception of alternates, you have been in the alternate industry. And you as an exception, you have been with a fund house which has mutual funds, alternates, and PMS. So now specific to public market investing, so how do you differentiate when it comes to alternates investing? So for me as a layman or an investor, I find everything to be the same except for different nomenclature. How alternates public market investing is unique, or how do you differentiate that?
Sure. Let me try to answer that in the following manner. Actually, stepping back, if you look at what's happening to the mutual fund industry. So the mutual fund industry has grown splendidly, is an outstanding industry, done extremely well, given us great managers, etc. But what's happening along with scale is that this business is getting that much more regimented, right? So there's only that much you can do. This is what you can do in a mutual fund. Your, so to speak, flexibility is a lot lower. And what that is therefore, incrementally if you see, and at one end, of course, you have, and Shrikant alluded to that in his speech, that you have mutual, on the large cap side, you have more ETFs, etc. coming in. You are getting, you know, the mutual fund industry in that sense is getting squeezed out. The ability to actually take a greater amount of risk, maybe generate a greater amount of returns, etc., is now getting reduced. And you can see that in the returns of mutual funds as they are more or less getting, you know, getting closer to each other. Investors, and as wealth is getting created and significant wealth is getting created and will continue to get created, incrementally a lot of investors are seeking, let us call it, a potential for delivery of alpha. And from that perspective, an AIF and a PMS, where there is a greater degree of freedom, right, and where you can also, depends if you are an institutional investor or a large investor, also give a specific mandate to a manager to be able to, you have the potential to, I'm not saying you will necessarily deliver that because it may or may not work in that way, but you have the potential to deliver alpha. And to my mind, you will have a lot more of you know, investors seeking this. So why are investors, for example, going into the PMS AIF space? Partly to an extent is, ab large cap MF mein to itna hi kar sakte, so to speak. Even in a small cap MF, you've seen, I mean, the amount of large cap holdings which are there, and when you run a small cap fund of 50,000, and all credit to some of my colleagues who are running those sizes, because that is incredible to be running in a small cap fund, but you necessarily have to diversify. You have a lesser ability in that sense to deliver alpha. So to that extent, the primary reason to my mind, I would put it, and that's from a demand perspective, you see a lot more, let us say, appetite for something which is different. And in a more, let us call it optimistic market conditions, there are investors who gravitate towards that. So that would be, I would put it from a demand side, right? From a supply side, and supply also creates its own demand in that sense. You've got great managers now moving to, a lot of great managers also moving to the mutual, so the AIF PMS side, to the alternate side. In fact, on a lighter note, one could argue that most of the senior guys are anyway moving to the AIF PMS platform. If you actually look across the industry, and while it is said in jest, there is truth in that. There are a lot of senior guys moving out there. It probably gives them a better way to express themselves. It gives them a better way to, you know, really participate and deliver alpha closer to what they want to do, right? Because, you know, like I said, the starting point is maybe this is a platform which offers more flexibility, more freedom than what might be afforded on a mutual fund platform. I hope I've answered you.
Yeah, absolutely. So since you ended your note with alpha, so I would just go to Vaibhav. So Vaibhav, you are an outlier on the panel. So again, the panel is also very long biased. Okay. So you have been managing long short funds. So when we talk about AIFs globally, so hedge funds like, so they use multiple strategies. Like long only is very, very small portion of the global hedge fund portfolio. You have market neutral strategies, you have event driven strategies, you have arbitrage strategies. Whereas in India, if you see like almost, I would say more than 80% or 90% is long biased. So if we have to create that unconventional alpha, so, and just to add to that, like we have seen a perennial bull markets for the last 10 years, maybe bouts of volatility here and there, but just contrary to our belief, in case if you see next 5 years of bear markets, so definitely long short strategies could be the right option. So what is your take on this?
So the way I would look at is basically it's not long only versus long short from a portfolio perspective, because when you are kind of, you know, having your meal and you will have different components of your meal, right, from protein to fiber and everything, right? It is the same way when you look at a portfolio, you will have components for longer term wealth creation in terms of long only equities. There would be a good amount of component in terms of uncorrelated returns as well to try and balance out the portfolio should the market be, you know, not as favorable as one would have estimated. So the point is that long short again is just a tool to kind of manufacture strategies which are extremely conservative in nature, to being very aggressive as well. How you use the tool, how you devise your strategy, it's upon the manager's core competence in that sense. And how does it fit the bill in terms of a client's portfolio, and how it can add value to them in terms of generating that kind of risk-adjusted return is extremely important, right? Now, there is always a impression that long-short strategies are not good for the kind of bull market in that sense. But as I mentioned, that there would be various, and because of the AIF vehicle, which gives you huge amount of flexibility in terms of managing the strategy, including your leverage piece, you can actually generate lot better alpha with a superior kind of risk matrix as well. Now, when I talk about risk, it can kind of vary right from understanding the standard deviation or volatility of the fund to drawdowns or measuring the drawdowns as well. What long short gives you an edge, an additional advantage, is also to try and mitigate your behavioral psychology of investing into markets. It kind of addresses that fear of investing into markets, where you know that here is a strategy which has the potential to kind of give you uncorrelated returns or probably protect you from the downside while investing in the markets as well. So that's a comfort which gives, at the same time generating that kind of alpha from a typical asset class as well. So long short in that perspective is a all season kind of strategy as compared to a long only strategy, which typically will be good in the kind of bull markets.
Rightly said, Vaibhav, like providing diversification and uncorrelated returns is of paramount importance for somebody investing in alternates. So now slightly shifting gears and just moving to Pankaj. So again, just dwelling on the same alpha generation, since you come from mutual fund background, see last 4-5 years, well, just about 20% of the investment managers have generated alpha across large, mid and small caps. So that could be aberration, even on a 1 year, 3 year and 5 year period. So 80% of the fund managers have not been able to beat the benchmark. So one, there could be the informational efficiency of the markets could have increased, but still as an investor, I just look at benchmark as a barometer. So considering this, is there real opportunity for alternates to deliver, even though most of the alternates are absolute return and not linked to benchmark, but as an investor, I always link it to the broad-based benchmark. So even though data is not available, what is your take on this? Because like even in mutual funds, a lot of money is getting drifted to passives, smart beta, all of that. So maybe just some light on this.
Yeah. So first, I think there's a bit of myth that most of the industry is not generating alpha. I think alpha is cyclical. And if you look at, for example, till year before last, all large cap funds were underperforming over a 1-3 year on Nifty. But suddenly last year you saw 80% of the large cap funds outperform, and the opposite was true, that 80% of mid cap and small caps underperformed. So if you do on a rolling basis over a last decade perspective, you will see that there is no consistent trend in alpha in terms of every category wise, and alpha is cyclical. So the main comment by mainstream media that Indian managers can't generate alpha, I don't think is right. It's more cyclical in nature. You need to understand that part. Having said that, I think there are some constraints now which is prohibiting significant alpha generation, which we saw maybe 10-15 years ago. One is the size which Shahzad spoke about. I think I was managing the second largest mid-cap fund of India, which was about 38,000 crores. So from a practitioner perspective, I can tell you, my universe kept on shrinking as the size kept on increasing. That means the alpha opportunities kept on coming down from a universe perspective. And that's a real problem, right? Though the markets have expanded, but the executable ideas keep on shrinking as your size increases. And across the board, when you look at the two spaces, which is about 5.5, 6 lakh crores, which is mid cap and small caps, I think the alpha generation will be limited because the sizes have become very large for the funds. On the same breath, when you look at AIF, a good part or a bad part is that you can't onboard more than 999 investors at the moment. Maybe regulator may change it later on. That will limit the size of the fund to a particular size. Once your 999 folios are off, you have to stop onboarding the clients. And assuming a ticket size of whatever you can kind of visualize, your fund can range between 5, 10, 15,000 crores, that's it. Which will give you enough flexibility on execution perspective from an alpha generation. And I think that's the reason you will see slowly and gradually informed investors, large family offices, UHNI, drifting towards this part in search of alpha, which probably could become a little difficult. And now the regulator has mandated one fund in a mutual fund in one category from one fund house. So if my size was 38, 40,000 crores, I should have been allowed to launch a second fund, which was not the case because of the regulation. I think that flexibility is there on the alternate platform as we speak today. And I think that's the reason that over a period of time, if you ask me, that could be one of the important reasons. And flexibility in managing in terms of capitalization also is an important feature which your alternate provides, which the other platform doesn't. So I think that's one very, very important reason in search for alpha. I think this space can gain prominence as you move ahead.
If I may put it like this way, so because of the regimented nature of the mutual fund structure and size constraints is what the alpha generation limitations.
See, regimentation, I think as the size of AIF and PMS increases, I'm pretty sure that regulators will bring in more and more, in terms of regulations and discipline. That we should not take the arbitrage and say that this is the arbitrage which is there. At some point, this arbitrage will be closed. You should prepare yourself. Understanding what is happening in the MF industry will also come out here. So don't understand that the arbitrage will continue for an indefinite period. At IKIGAI, trust me, because I come from 2 decades of mutual fund, all my processes are tuned to the same thing which we were doing at mutual fund. Today, dealing room is not a compulsion in AIF. But right from day one, we have a surveillance-based dealing room right there. So that when the regulator comes in and moves out, we will be the first to adopt it. So I am not talking about regulatory arbitrage. What I am saying is a practitioner aspect. And that practitioner aspect says that because of the limitation of 999 investors, size being constrained, you will have an opportunity to be more flexible in nature as you move ahead. And that will give you enough scope for flexibility.
Okay. Thanks, Pankaj. So taking cues from Pankaj, Shahzad, the question is to you. See, mutual funds, you also mentioned mutual funds are a very homogeneous structure. So today, if I have to analyze a mutual fund, just there are umpteen number of platforms which are there. Just go analyze the risk, return metrics, performance, whatever analysis you want to, just by click of the button, you can just analyze the performance. Whereas when it comes to alternates, as an investor, one is the performance persistence of the fund, is a question mark. Second is the difference between the top quartile and the bottom quartile performers are very, very large. Considering these two, as an investor, how do I select a fund? Vis-a-vis, it's very simple to select a fund in mutual funds.
Sure. Okay. So let me try to answer it in the following manner and actually invert your second question. So which are the funds which are where the returns across different fund houses are very similar? You'd probably say liquid funds. You would probably say the overnight funds. You would say ETFs. Why? Because, well, they just replicate the index. Or in a liquid fund, kitna difference ho sakta hai? 3 basis points, 5 basis points between the best performer and the worst performer, right? Maybe. When you look at the alternate investment platform or the and it comes to the reasons which your last two questions which we addressed, is that incrementally investors are going or are seeking, whether it's a PMS or an AIF, they're seeking alpha. They're coming there for that alpha. Now that alpha may be delivered, it may not be delivered. There is no birthright any investment manager has कि वो outsized return दे पाएगा, right? You may not, very well. What you are seeking to do may not work at some point in time. So there is incrementally, the more regimented, the more, if I can only pick from a pool of 100 stocks, chances are, well, those funds will give returns which are closer to each other. When I have a greater freedom to choose funds, when I have a differentiated strategy, I could. So that's point number one. Point number two, I think we also have to realize that mutual funds is you know, it's very, well, there is a large cap fund. In a large cap, you can only do so much. In a mid cap, and so on and so forth, you can only do, well, certain things. You have, again, the greater freedom in the PMS AIF platform to be able to do it, and consequently you will continue to, you will continue to have that differentiated return between the larger and the smaller guys. Also, see, strategies are very different. Udhar is very clear hai, yehi strategy kar sakte ho. I'll add a couple of other points here. This is, of course, more in the public space where it is more available right now, and you have different vendors do it, as well as you have, so the data is more available. In the private space, I don't think you're talking about, but that gets even more difficult because of which vintage are you of, and so on and so forth. And it can, the things can vary very, very greatly. If you were a VC fund in a 2020 vintage, or you were a VC fund in a 2023 vintage. So those returns vary greatly, but there are a lot of efforts being done to address that. Yeah. So your question, your question was on what do you look like? What do you look at? So you'd look at a fund house. You'd look at, when I say a fund house, it could be an entrepreneur. You could look at the sponsor. Who is the sponsor? How deep pocketed they are. I may just add one thing here, that the table stakes are a lot higher. 5 years ago, you could start a business with, a PMS business with 2 guys, 3 guys sitting out of an office. Aaj aap nahi kar paoge, right? These table stakes are that much higher. It is that much more expensive and involved to do it. So, you look at your sponsor, you look at your financial strength, you look at the investment manager, his track record, what it has been over a period of time, and the institutionalization of this. What are you investing? Is it just something that, is it a bit of a mom and pop show, or is it somebody who's investing for a longer term perspective, right? So the various things you'd look at in selecting is primarily, again, sponsor, investment manager, strategy, track record. Of that is what I would focus on. Yeah.
Sure. Thanks, Shahzad. Samir, now the question is to you. Like, I just read your recent wealth report. Very good efforts in terms of, like, it's very, very intuitive. So one thing I just picked from that report is, like, so today there are, like, what, 1,200 plus alternates, and every month there is 100 plus alternates getting added. So the investment managers are from broking houses, mutual funds are opening up, PMS houses are setting up alternates, and now there is a new set of bandwagon of people, all the wealth managers, the distributors are also just doing a backward integration into manufacturing. So this was a success story. 361 Kotak was a success story, and even ASK was one of the classic success stories. Now recently, if I see Client Associates, Julius Baer, and multiple names are coming in. So don't you think it's getting an overcrowded market, 1,300 plus? Now every distributor comes with a AF. So where do we see this? And most of them are coming in public markets.
Yeah, that's where the honey is. So that is attracting. So it's very natural. I mean, we have, again, the pool of talent, and we are just starting to get wealthy as a nation. We have not seen wealth, and if wealth grows beyond a point, like I have met so many family offices recently where wealth has grown beyond a level where they can manage themselves. So it has been somebody was managing direct and honest. They are honest or true to themselves that this is beyond my capacity to manage, and either I need a wealth manager or a AIF fund manager or whatever. So that recognition, and that's what is going to happen. As wealth grows in the country, you will need professionals who can manage, whom you can trust and who can manage your money. And it's going to be that way. Big will get bigger. There is no choice, and I concur with Shahzad that now it's no longer good to be small. Nobody will have a choice given the compliances and given the costs involved. everybody will have to scale up. So which is what everybody is realizing and, you know, kind of launching whatever it is. Water will find its level, you know, performance. We've seen the ups, we've seen the downs. What we used to hear in PMS also 5 years back, you know, there were so many, there is always a new kid on the block and this and that. And then over 10 years, 20 years, you will know that only 5, 10 will survive. So it's happened everywhere, it will happen here. It will be large part of the profit pool will be the top 10, 12 guys. Rest of the guys, it's a profitable business. Everybody will survive, everybody will do well. So in that extent, this is not a gruesome business, but only a few will make really big money.
Thanks, Amir. So, Vaibhav, now one question to you is like, see, whatever said and done, most of the, as an investment manager, okay, you talked about uncorrelated returns, diversification, but I tend to see most of the fund managers tend to hug the benchmark. As we already discussed, benchmark is the barometer. But since you operate in an absolute return strategy or benchmark agnostic, so do you think like this mentality of hugging the benchmark would change? And now more and more interest is coming on the typical so-called hedge funds. So in that being the case, can ASK be the next Bridgewater or Renaissance?
Would love to. But, you know, when we talk about benchmark, right, I think an absolute return of funds, I come back to the same point which I had earlier mentioned is when you're using long short as a methodology, you can do both, right, while generating that absolute return fund or absolute returns, or probably, you know, having index as a benchmark and try to better that by giving an alpha, at the same time improving in terms of the risk profile as well. Now, the whole center in all the kind of conversations I've heard is the centerpiece of you know, the discussion with the investors is always returns, you know, and returns alone, right? Rather than looking at the sustainability of that returns. And when I talk about sustainability of the returns, it starts right from the investment process on an institutional basis to risk monitoring mechanisms, and also the softer aspects, to your earlier question, is the conflict of interests as well. Meaning when we talk about, you know, interested parties being manufacturers, or, you know, in some way, and prop shops kind of getting into manufacturing, there is always an element of that conflict of interest one has to keep in mind, right? It just takes probably an event to have the whole sustainability of returns kind of you know, put in question. So there are a lot of factors which one has to evaluate before choosing, you know, an AIF or the fund which is kind of suited for your own portfolio or financial kind of goals. So my sense is I think industry will evolve over a longer period of time. A lot of education is needed. The underlying risk factors which everybody has to look for, all these kind of you know, will happen over a period of time. The education, as education will increase, people will understand the importance of each of these kind of elements.
So one last closing remarks. I think we are overshooting the time. So just half a minute for each of you. So since all of you run the own funds, what is the role of fund administrators like us? In what value add we can do for your job is alpha generation? Beyond alpha generation, what is that something you should look at? Yeah, each of you.
So I'm the new one on the block, so I can tell you my experience over the last 75 days. I think had Kfin not been there, we would not have been able to do what we have done. I think we took a lot of time evaluating a lot of fund administrators, and I think what kept them very differentiated was their tech platform. And I can tell you with our experiences that it's been just phenomenal. 70% of our onboarding has been digital. When we were entering into the space, everybody scared us. Forms होगा, sign कराना पड़ेगा, 15 signature आएंगे, ये होगा, कैसे manage करोगे, logistically, people, ये वो. And I can tell you with our experience, it's just been phenomenal. Whatever Shrikant spoke just before this is absolutely true. We are just focusing on client side and fund management side. The rest is all taken care by Kfin guys. I can assure you, fantastic help. I have never seen any fund administrator going and walking the extra mile and helping us out. So I think in this journey, when the industry explodes, I think they have a major, major role to play on all the aspects of, right from onboarding till the compliances, from attribution, fund fact sheets, all these parts. I think you guys will be playing a major role, especially in the boutique investment firms.
Thanks, Pankaj. It's like really, we are really blessed to hear these kind of kind words from you. So fantastic.
Just very simply, it's as follows that, especially on the AIF side, PMS side too, the players are typically come more from an investment management background, where the focus clearly is on keeping, focusing on the key things, which is the key things is investment management, firstly, because if this is a kitchen, right, if this is a restaurant, you focus on, at least the way I see it is, if investment management is a restaurant, you focus on the cooking, so which is the kitchen, so the fund management, followed by client relationship, etc. And on the back end, etc., you would like to leave it to somebody. And then the smaller guys, to that extent, anybody starting up, you would like to do it. Also, you would not like to incur too much costs because, costs, as we all alluded to, were going up rather steeply. You want to keep that low. You want to keep everything down to variable cost to that extent and not put, significant amount of investment in infrastructure yourself, or we may not have the capability of doing that. So from that perspective, it would go, and as digitization increases, which is constantly increasing, etc., the role, to my mind, will only be that much more. And to that extent, your stock will also make a very good investment option for all of us.
Yeah, thanks. This is another perspective to it. So closing remarks from both of you.
No, I think, just voicing seconding the opinion is, see, we are good at generating, or managing money in that sense. So everything other than that, taken care by the service provider would be kind of huge help, and especially in the ever-changing regulatory environment, right? To be very honest, we don't want to spend much of our time probably, catering to those kind of things. So, we'd love to have more of technology, more of automation, and levels or layers of analytics, within the industry would be really helpful.
Thanks.
Yeah. So last, you are going to have a major share, in our industry, and I think of it not as outsourcing, but you are an extended arm of, what we are going to do. It is the kind of technology or digital servicing that you can provide, and that is where you will have to be ahead. I have seen many who got to 80% market share stagnated and whatever. So my ask would be to continue, being ahead. That is how the industry will grow. So help the industry innovate and keep the operation smooth. That's it.
Thanks, gentlemen. So it's been an excellent panel, and thanks for being a part of this panel, and thanks, audience, for your patient listening. Thank you.
Thank you.
Thank you to our esteemed panelists for such an informative exchange. This was really, really, really helpful, I think, for our audience. And thank you for being here. We truly appreciate it. Can I please call Mr. Chandrasekhar on stage to felicitate our panelists, please? Thank you, everyone. Now we will take a short tea break. But before we do that, let's have a little bit of fun and test your knowledge with a small quiz. We have exciting prizes waiting for our winners. So let's kick off the first round with questions. And for that, I would like to call Ms. Rakhi Bhatija on stage, please.
Hi, everyone. I know you all are waiting for a tea break, but just let's jiggle your mind with a couple of riddles. Just to give you a hint, it may not be financial. I know all of you are finance people here, but we need to think otherwise as well. Rest assured, there are some power-packed prizes as well. So 3 questions for this round, and then we'll have some few quick fun sessions after every discussion here. Let's see which the first one. I may sound violent, but trust me, I shield. I manage your risks on the investment field. What am I? Whoever knows the answer may please raise your hand. We'll give you the mic. I think I need to repeat. I may sound violent, but trust me, I shield. I manage your risks, that's the cue, on the investment field. What am I? Yes, the lady in red. We could save that answer for later. Thank you for trying. Yes, Sushma. I may sound violent. I'm not sure whether a compliance officer is violent. Anyone here? Okay, after the lady in red, we have the gentleman in red now. Sorry? Risk committee. Our risk committee is violent. Okay, I think, can I give you a hint? It is a fund, and I'll repeat it now. I may sound violent, but trust me, I shield. I manage your risks on the investment field. It's a fund. Yes, somebody is prompting. Please give me the answer. Absolutely. Thank you. Yes. Please, can we have you on the stage, please? Thanks. And the next one. What is it that no one wants, but no one wants to lose it either? No one wants a job? No. I wouldn't second that. No one wants it, but no one wants to lose either. It's definitely not marriage. So don't give me that answer. Something related to law? Yeah? No. Absolutely. Thank you so much for the answer, and may we present you with the prize, please. It's a lawsuit. No one wants, and no one wants to lose it either. Thank you for answering. What has 4 wheels and flies? Four wheels and flies. Let's think about flies. Where do you find flies? Feel free. Yes, again.
Garbage truck.
Bravo. Well, great. We can give 2 prizes, please. Please pass it on to him. Thanks. Yeah. Thank you for participating. We'll break for tea right now. And we'll keep having these quick sessions between all the panel discussions. We also have a lucky draw, which we will be taking through. 3 lucky draws with interesting prizes. So please hang on. Thank you so much.
Thank you so much, Rakhi, and congratulations to all the winners. We will take a short break for 15 minutes. So please be back by 12:25.